Good afternoon or good morning, wherever you may be located at. My name is Karen Grease, and we're fortunate today to have Gideon Gradman and also Larry Moore joining us to talk about the Inflation Reduction Act, what higher education institutions need to know now. Going on to the next slide, as you know, is the Inflation Reduction Act actually passed. It's hard to believe that it's a little less than 3 months ago when we started talking about this act. And I remember going through the act and the number of pages to see exactly how is this applicable to our tax exempt organizations. Now, I have to say, I'm very thankful to our energy team and individuals like Gideon that are familiar with the credit regime and that they were actually integral in helping us unpack all of the various credits that are available and how this applies to us as an institution of higher education. We know that the $499 billion of tax cuts or new spending that's available is very significant to us in our regime. Going on to the next slide. I'm not going to spend the entire time reading through this slide as far as the various bullets, but I think it's important to note that a third of that $499 billion is for clean electricity tax credits. And of that, we have another significant subset for clean energy tax credits. And why is that important? It's important because higher education and nonprofit organizations are actually eligible recipients or beneficiaries of these credits. When we look at the deferred maintenance we have on our campus, maybe some of our planned projects that are coming up, or even our ESG initiatives, our environmental, social, and governance initiatives, these credits or the energy incentives actually flow directly into these benefits that we now have an opportunity to capitalize upon. So we're going to spend our time talking about the tax credits, or the majority of our time talking about the tax credits today. But I think I'd like to hear, Larry, can you tell us about some more opportunities that we see that are actually within the Act besides the tax credits?
Absolutely, Karen. Excuse me, a little frog in my throat there. So if you go to the next slide, in addition to the tax credits, you'll see that there's quite a bit of funding for a variety of grants and loans. And I'm not going to go through all of these bullet points. You can go back and take a look. Some of them may be applicable to higher education institutions. Many of them won't. So you can certainly take a look at this. We always look at these types of things as we look at the overall applicability of energy credits. We always look for additional funding in the event that there may be additional funding. What I am going to do now, though, is I'm going to introduce our first polling question. So hopefully you guys are awake and ready to take this poll. It'll pop up on your screen shortly. I'm not seeing the polling question come up. Am I missing something? Okay, well, I guess we'll move on then. So, Karen, who can qualify for the credits, and why is it important or impactful to tax-exempt higher education institutions?
Yeah, good point, Larry. Is right now the reason why it's impactful to us as a nonprofit organization or institutions of higher ed is we're now eligible for these tax credits. Previously, as an exempt organization, we were not actually eligible for many of the tax credits. What we'd have to do is actually establish a blocker corporation, put another entity in place in order to have these tax benefits that have always been out there, or certain energy credits that have been out there for manufacturers and other types of for-profit entities. For myself, practicing in the exempt tax space, I would have conversations with our higher ed clients talking about blocker corporations in the context of alternative investments, not in the context of construction projects that are on campus. So that's why I think this is so very important. But the game changer for us, in my opinion, is the direct pay provisions that basically is saying that it allows for the monetization of certain tax credits by receiving an actual cash payment. And again, this is really a game changer since we can realize these cash benefits to offset project costs that we have on our construction projects that are occurring on campus. Now, when we look at the complexity of having to put in place a separate corporation, it's no longer required. So again, this is what's exciting about the act. I think there's over 300 some pages that Gideon's team and others have unpacked regarding the energy credits. That's why we're so excited about it. Looking at the next slide, it becomes a question of, if we have these credits that are available, what types of projects are eligible for the credits? You know, how big is this energy piece? And just to use the term, I could say it's huge and end at that, but it really wouldn't give you some information. You know, what we're looking at is if you have wind, solar projects, if it's, you know, on a rooftop or on the ground, hydro projects, you know, Gideon's going to spend some time talking about an example about heat and power on campus. You know, maybe there are some upgrades that you're doing on campus that would be eligible. Biogas would be eligible, or something as simple as, you know, replacing your gas vehicles within your fleet with electric vehicles could be eligible for a credit, and a significant credit depending on the number of vehicles that you're potentially placing in service, or even the electric vehicle charging stations are eligible for a credit. I think as we were talking about it as a team, we were commenting at all the various businesses within our where we live that are currently putting charging stations in. Those projects are now eligible for a credit.
Yeah, and Karen, I think it's important to point out here that all of these credits, or the so-called old credits, and we'll talk about the new credits in a little bit, have been around for a long time. The issue is that it's just really not been all that available for tax-exempt organizations because you don't pay tax, and so no benefit for taking the credit. What's important to know is that for-profit organizations have been doing this for more than 10 years, and Gideon, who leads our energy practice, really has been assisting our for-profit clients in this area and helping them identify those types of credits. So as we get into this, and as you as a higher education institution start looking at the credit opportunities, it's important to know that this is not new to everyone else. It's just really new to you. So Baker Tilly can really provide assistance in this area for you as you figure out how you're going to get this extra cash. So as Karen pointed out, you know, this is going to be a direct pay is what the terminology is used in the code. But basically what that means is cash refund, money to help you with your projects. You can't get too excited too early because you have to wait until the project's placed in service, which we'll talk about a little bit more later, before you can get the cash back, but you at least know that it's coming. So that being said, what are some of the new credits that are being introduced with this act? And those, surprisingly enough, are on the next slide. So as you can see on the next slide, that there are a variety of new credits that are being added. Not only is Congress expanding the old credits, but then they are also introducing these new credits. And while not all of them are going to apply to higher education institutions, you know, you can look at a couple. If you look at, for instance, the Solar Production Tax Credit, or PTC, that's new this year. There used to be there still is, a solar investment tax credit, and now they've added the production tax credit as well. And we have an example on that later that Gideon will talk through. A couple of the others that you might want to take note of are the energy efficiency construction credits that are out there. Those are maybe opportunities for higher education institutions. And then down and below, the EV, the electric vehicle credits that are now there, are applicable both for commercial, i.e. higher education institutions, as well as residential. So now I think, Gideon, if you could talk us through the value of the credits, including the so-called add-on percentages, and provide some common examples, that would be wonderful. Gideon?
Thank you, Larry. And as Larry mentioned, I help lead our energy and infrastructure practice at Baker Tilly. You can go to the next slide. And what I'm going to do is talk through really the framework of the Inflation Reduction Act and how it might apply mechanically to your projects. So as Karen mentioned, a new feature of this act is the direct pay provision. So it allows a tax exempt or nonprofit organization to have access to tax credits, which turns these credits into essentially cash grants or cash refunds back once a facility is placed in service. And in general, there's a broad framework of the act, which I think makes sense to sort of explain as a framework, and then we'll go into how each applies. All of the credits that we've mentioned have the same basic structure under the act. You have what's called a base credit, and you have bonus credits, and it's designed this way to create incentives for developers and institutions to build their energy facilities in a certain way. So the base credit across the board is generally 6% for qualifying energy projects. And so there are specific types of projects that qualify, which Larry went through. And the idea is that you start off with a base credit, and they give you a very extreme incentive to do all of your construction projects using prevailing wage and apprenticeship rules. So they're trying to incentivize project developers to pay higher wages to project workers. And to do that, they are making a significant incentive for a project to comply with the prevailing wage and apprenticeship requirements under the law. And if you do comply with that, you get an automatic 5 times multiple to your credit. So a project that has a base credit of 6% is now worth 30%. So what that means is that 30% of your qualifying costs for that energy project, for example, a solar facility, would then be available as a refundable tax credit under the direct pay provision. In addition, they have special bonuses for certain special situations that they're trying to promote and incentivize. So in certain cases, some credits give you an additional 10% bonus credit for domestic content, which means that they want you to buy American products, they want you to buy American equipment, and there are specific rules in the law around what percentage of the total equipment needs to be domestically manufactured. And if you meet those requirements, you would get an extra 10% of your qualifying property to qualify for the credit. There's also special provisions for places that they call energy communities, because this entire act is focused on the energy transition, on transitioning the U.S. To augment and broaden its energy base and its energy generation fleet. It's understood that when you promote and push more renewable energy, that also means a decline in the use of traditional fossil energy. And so this is a provision that's meant to focus on communities that traditionally were areas where coal was mined or where coal-fired power plant generation existed and has recently been shut down over the last 20 years, or where you have a high concentration of labor that works in the oil, gas, coal, and mining industry. And so if there are specific provisions and rules around what communities qualify, and if your university is in one of those communities, a good example would be a place like UC Boulder, where Boulder is a city that has had coal mining and coal-fired generation in the past. That may well qualify as an energy community, and you would get an additional 10% on the qualifying property for your energy project. And finally, specifically for the solar and wind, small solar and small wind projects, there are low-income community and environmental justice bonuses. So to the extent that a project is being created in a low-income community or in a community that's defined as an environmental justice community, it can be eligible for additional 10 or even 20%, depending on the specifics of the project. So that's the general framework of the whole act. And what I'm going to do next is give a couple case study examples that are particularly applicable to universities so you can get a sense of how this might be implemented on your campus. You can go to the next slide. Many campuses have, as a major part of their energy system, central utility plants, or just generally campus energy systems that provide power generation, steam, hot water, heating and cooling throughout the campus community. These are often key pieces of energy infrastructure on campuses, and these are often critical for the operation of the facility. Everyone is looking at how they can keep those facilities running and upgrade them, and more are looking at the sustainability of their campus and seeing how they can make those facilities more energy efficient and cleaner. And so one part of the investment tax credit opportunity under the law is the combined heat and power investment tax credit. This, what they call it, a CHP credit. What's interesting about the Inflation Reduction Act, this has always been an opportunity for an investment tax credit, but they significantly increased the credit amount under the law from 10% of qualifying property to 30% of qualifying property, assuming that you meet the prevailing wage and apprenticeship requirements that I mentioned before. And there's also opportunities to have that additional bonus credit for domestic content if you choose equipment and supplies that are domestically manufactured. So this is a significant opportunity for campuses who want to upgrade their plant, deal with deferred maintenance of their central utility facility where you have a combined heat and power facility. And I should mention, if you're not familiar, combined heat and power means that when you have a power plant on the campus, that power plant could be burning various fuels, for example, natural gas. And an efficient power plant also captures the waste heat that's recovered from the combustion of the natural gas and then uses that waste heat for usable energy. So it's usually used to make steam or to make hot water that's circulated throughout the campus. This is a very common setup at a lot of campuses, and I'm sure many of you have these types of facilities. So this is an opportunity where you can take advantage of these credits to upgrade your equipment. It also can be used in conjunction with expanding, for example, microgrids or on-site renewables or energy storage on the campus. All of these are often in the news as things that people are talking about to create more sustainable campuses, to create a resilient campus environment in the event of a blackout or a storm. And so things like microgrids and on-site renewables and storage are also eligible in the Act for various levels of the investment tax credit. And so you can combine all these credits together as you think about your overall energy plan for the campus going forward. And this is something that we help clients do all the time and can help you as well. And I think it's important just to remember that because you have the opportunity for direct pay, the way that would work is you would still have to spend the initial capital on the property when you develop and implement your new facility. And then once you file the appropriate documentation at the end of the tax year in which you implemented the facility and place it in service, you then would get essentially a refundable tax credit back via the direct pay provision.
So Gideon, if we're doing a bunch of projects at the same time, do we have to wait for all of them to be completed? So let's say we do this, then we do a solar panel on another building and these sorts of things. Do they all have to be done, or each project stands on its own?
Each project stands on its own. Now, sometimes they are related, and so you have to, it's on a case-by-case basis, but each project has its own investment tax credit. And so when you place a piece of your campus energy system in service, that placed in service date is a key date after which you then earn the credit and can file for it to be direct paid. And so you can do this over time. The central utility plan is often a pretty large project, whereas putting solar on various rooftops throughout the campus or adding battery storage on your campus might be smaller, shorter timeframe projects, and you can do them over time, and you can then file for those direct pay reimbursements at the completion of each project.
So when you work with clients, can you time projects so that if we get one project done, then we can apply for the direct pay and then money can come in that can help fund projects down the road?
Absolutely. Normally what you think of the direct pay of the credit is really a reimbursement for capital spent on a project that's placed in service. So you essentially need to bridge that funding gap during the construction and operation phase, and then within 12 to 18 months, the Treasury still hasn't given full guidance on what the timeframe will be, but you should probably assume 12 to 18 months is the lag that could happen between the time you file for your credit and the time you receive it. And that's something that's going to be clarified in the future.
Got it. So we probably need interim financing to pay for the project, and then
That's
when
correct.
we get the credit, we can either pay off the interim financing or we can use that for subsequent projects.
That's correct.
Oh, okay.
You can go to the next slide. This is another example, very common on campuses. Everyone's looking at putting solar energy generation on campus. That could be either done on rooftops, on buildings. It could also be done as a utility scale solar facility. A lot of campuses that are landed campuses that have quite a bit of property can also look at large scale installations for generation. But the most common is putting solar on rooftops or on buildings. And so this is an example that I put together just to illustrate what a 1 megawatt solar project would look like. And in this example, we just estimated about $1.5 million project with a 20% capacity factor, which means that 20% of the time it is generating electricity. So it's on sunny days when it's not dark outside, that's when it's generating electricity. And we made some assumptions around the power rate in a certain area. But the idea is that in this example, where before there's always been a solar investment tax credit, the difference is that now there are these bonus requirements or bonus opportunities if your project, for example, uses domestic content panels, if they happen to be in an energy community that I mentioned before, or if they happen to be in a low-income community. Those give additional 10% investment tax credit bonuses to your total project reimbursement. So in this example, you can see that at the bottom of the table, that would be a project that gets no investment tax credit. So previously, a campus, a university, an exempt organization would not qualify for the investment tax credit. So your payoff period in a very good sunny environment would be about 8 years on that project. If you then now take a 40% investment tax credit, which would be an example where you met prevailing wage and apprenticeship and you hit one of those bonus criteria above, either domestic content, low income community, or energy community, you can see that 8 year payback goes to 5 years. And as you qualify for more and more bonuses, depending on where your campus is and where the project is implemented, you could get that down pretty low to 4 or 3 years if you happen to be, for example, a university that is in a low-income community, that's also an energy community, that's also using domestic content. That's how you get more and more of the credit. So it really shows how these campus projects can, because of the new law, can have their payback period significantly reduced, make them very, very worthwhile for the campus. And again, this is a common opportunity for campuses. I should note, though, that this project assumes not the sunniest place in the world. So if you're building at the University of Arizona or you're building at UT, in West Texas, I should say Texas Tech, that may be a sunnier place, and so you may have a higher than 20% capacity factor and therefore a shorter payback period. I think we're going to do a polling question next, so maybe you can bring the next polling question up, and I'm going to pause and wait a minute while people can answer the question.
So what you're basically saying is that if we're in a more sunny location, we have potential better benefit from the solar credits than if we're in a less sunny or warm location?
It's not a better benefit from the credit; it's a better benefit from the solar panels. So you're going to produce more energy in a very sunny place, which reduces the payback period. The credit actually would be the same. So the credit's quite valuable for a cloudy place, because it might not have the best business case to install solar panels in all locations, but with the credit, it makes it worthwhile.
So that's why it's important to really look at the difference between the ITC, the investment tax credit, versus the production tax credit, because depending on where you're at, will dictate which one you would choose.
That's correct. So this is more of a cloudy place, and so the ITC would certainly make more sense. If you're in a very sunny place, you may want to investigate, and we can help you compare the business case between the investment tax credit and the production tax credit. We do that for clients and help you make sure you get the best choice.
Excellent. Okay.
All right, so we're going on to the next slide. I think this is just a third example that I thought made a lot of sense for campuses to talk about. And again, we've helped clients with these in the past. Alternative fuels and decarbonized vehicle fuel is a significant part of the energy policy that's being promulgated in the Inflation Reduction Act. So there's a tremendous push to try to decarbonize vehicle fuel. So move over time away from traditional crude oil-based diesel and gasoline and move toward alternative lower carbon fuels. So one way to do that is to look at electric vehicles. electric vehicles can be charged, obviously, by any electricity. But over time, the idea is that the electricity generation system throughout the country is going to more and more be relying on renewable energy as opposed to traditional thermal fossil energy. And so electric vehicles allows for the opportunity to charge your vehicles more and more with renewable energy. And so there is significant credit opportunity to subsidize the installation and purchase of new electric vehicles for developers. And now, because of the direct pay provision, that also applies to universities and higher education. So, for example, there are credits available for installing what's called vehicle fueling property, which includes chargers. And so you can be reimbursed for a significant portion of the charging equipment and installation, up to $100,000 per charger. There's also an opportunity to get a 30% vehicle tax credit for fleet vehicles that the campus may use. So if the campus has maintenance trucks or maintenance vehicles that they use that are owned by the university, they can be qualifying for the commercial vehicle tax credit. We mentioned here that there's also a personal vehicle tax credit, the electric vehicle for a new electric vehicle and also for a used electric vehicle. The used electric vehicle is new. That was not available previously. And the new electric vehicles, they've increased it. So there are a bunch of provisions on that tax credit to make sure that the vehicle you're buying has a lot of U.S. domestic content. That's something that's been in the news. So over time, more and more electric vehicles will be qualifying for this credit. Not every vehicle will qualify. It depends which ones. But it is available, and it's something that will certainly promote electrification of transportation around the country over the next 20 years. And finally, I think it's important also to remember that it's not just electric vehicles that you can use to decarbonize your campus. Many campuses are in rural areas where the electric system may or may not be able to handle a huge influx of electric vehicles because the transmission system might be limited. And so it's important to remember that the Inflation Reduction Act continues and expands the existing incentives for alternative vehicle use, and that includes propane-fired vehicles, compressed natural gas, and liquefied natural gas-fired vehicles, DME, and other low-carbon fuels. And when they say low carbon, it's lower carbon than diesel. So propane, for example, is a lower carbon fuel. Many buses, school buses and commercial buses are powered by propane, especially in rural areas. I'm sure many people have seen compressed natural gas buses all around different urban areas. That is an alternative to electric, and in many cases is more efficient than electric in certain regions, and the same with liquefied natural gas. So depending on your campus's region and availability of different fuels, you might also consider taking advantage of the tax credits for installation of refueling facilities using compressed natural gas or propane. So these are just three examples. There are many others that would apply. We can't cover them all today, but some of the Inflation Reduction Act credits could also apply, for example, to student housing and building energy efficient student housing and other areas. So in general, happy to answer questions on this webinar and afterward as you think about new projects.
So as we go on to the next slide, just going to comment, we do see the questions coming through. What we're going to do is we're going to hold them until we get to the Q&A session. Our goal today is to present for about 45 minutes, to leave 15 minutes for questions, to give lots of time to respond to questions. And to the extent we don't get through all of them, we will do our best to respond to them at a later time. So Gideon, what I heard you say was at first we really need to understand our opportunity because there's so many variables that are relating to different projects, different qualifications, what's a qualifying cost, what's not a qualifying cost, how do we optimize credits versus loans versus grants, these sorts of things. And then in addition to that, I suppose our higher education institutions have to really think about a couple of additional questions, such as, do your projects also qualify for state or local incentives? What's the interplay? Are the cost reimbursements duplicative? Do you have to worry about those sorts of things? And then finally, as Karen mentioned earlier, do any of these qualifying projects help you meet your environmental, social, and governance, the so-called ESG initiatives of the organization? And so what Baker Tilly does is we really come in and we look at this from a holistic perspective to say, not only here are your qualifying costs, but how can we interact with all of these other different provisions to make sure you're maximizing the amount of money you have for your project, what we call the capital stack. Let's go to the next slide. Further to that point, what we've done here is reiterated the comment around solar. So Gideon did a really nice job of going through the solar example and talking about the investment tax credit versus the production tax credit and which one is better or not. The key thing with this is you have to pick one. You don't get both. So that's why it becomes important to have somebody to sit down and take a hard look at it and look at your area and to determine, is it better to take the production tax credit because we have a higher sun content, if you will? Probably not the right word, but something to look at. And then on the second box over to the right-hand side, the other key thing is if you have projects that you are currently working on and looking to place in service here in the near term, you really should take a quick look now to see what your placed in service date may be, what your what's called the begun construction period is, because if you meet these rules under the begun construction, you have a safe harbor and you fall outside of the prevailing wage rules. If you meet that safe harbor, that just simply doesn't mean you don't have to pay prevailing wages. You can still do that, but it means you automatically qualify for the 5 times multiplier. And so that's why not do it and meet that test and take care of that so you don't have to worry about it later or worry about what those prevailing wage regulations say when they do finally come out.
Hey, Larry, if I could just add to that, this is a very interesting area and a very interesting moment for developers and entities who are developing new projects, because we are currently in this interim period. The Inflation Reduction Act has been passed, and as part of the law, they didn't want to slow down renewable energy projects that were in process. So what they said is that within 60 days following the promulgation of rules and regulations around the details that are going to be required for prevailing wage and apprenticeship, which hasn't been fully fleshed out yet, you can, as Larry said, take advantage of a safe harbor, which is to say, if you've begun construction on your project, and begun construction is a defined term, then you are automatically deemed to have complied with the prevailing wage and apprenticeship. And so right now they've not yet put the rules and regulations out. And once they do, you'll have 60 more days or 59 more days before you'll then be required to follow each of those regulations. So if that's particularly attractive for organizations or companies that have projects in the works, and meeting the begun construction requirements doesn't have to be that hard. There are 2 tests that you can meet either one. One can either be what's called the physical work test, which is what it sounds like. If you've done physical work on the property or on the project, that can count as begun construction. And you can also meet the construction by making certain financial commitments, whether it's buying equipment or even committing to buy equipment in the future through contracts. And there are specific ways to make sure you can do that contractually. They don't necessarily have to be very expensive, but they have to be done correctly. And if they're done, then you can be deemed as beginning construction and take advantage of this safe harbor period. So for those of you who are on the call who do have projects in process, this is something we can help you do in the near term. And I think it'd be very advantageous to pursue.
And the last I heard, Treasury was anticipating having those prevailing wage regulations or rules out by the end of the year. So that will impact our window a little bit.
Yep.
All right, moving on to the next slide. Continuing to understand our opportunity, what I'd like to reiterate in this slide is that when you look at your financing of your projects, be very careful, because as Gideon talked about earlier, that if you use tax-exempt debt, it's a 15% reduction to the amount of the credit that you receive. So as you go through this, take a hard look at what you're going to use as your financing and or dollars for these projects, and really think through the different types of financing that you may use. And then once again, on the right hand side, we've talked about this, but what we want to be really clear, because we keep getting questions on this, is that the tax credits are earned in the year in which the project is placed in service. IRS is going to issue guidance that will tell us how to file the tax return, what elections to make in order to get your direct pay back. Yes, it is cash back to the organization, to the tax exempt organization. So we've said this many times now, but the reason is because we do continue to get a lot of questions on this. A number of our clients especially are just amazed that tax exempt organizations are getting a cash benefit out of this and find it hard to believe. But yes, it's there. So let's move on to the next slide. So here, I think I'm just basically once again repeating what we've said before. Be aware of the timeline of the credits. If you do issue tax exempt debt on or around the period of time that you're doing construction for a project that you want to qualify for the credits, you may want to consider specifically identifying proceeds from the tax exempt organization to another project. This is quite common with tax exempt bonds. It's not required, but it'd be a lot easier if you had a board resolution showing that the tax exempt proceeds were not used for this project and they were specifically identified for another project. So that all being said, now that we understand the opportunity, Karen's going to talk about some recommended action steps.
Exactly. Thank you, Larry, and thank you, Gideon, for your valuable insight. This is obviously a very complicated area, and it's an area that as we're going down the processes with this project, we don't want to have any missteps that could impact the potential opportunity that we're looking at it. So right now, what do we have by way of action steps as we leave our time together today? What we really want you to do is step back and evaluate the deferred maintenance that you have on campus. What's in your plans, your facility plans that involve energy? Will those projects qualify for a credit? As Gideon had mentioned, and Larry touched on it also, we need to know what are the component parts? What's the qualifying property that's eligible for the credit? Because again, the entire cost of your project is not, it's diving deep into the components that would be eligible, similar to what Gideon does with his energy team, is looking at those projects. And perhaps there are projects that are not credit eligible. Maybe you're looking at certain projects that are not eligible for any of these new credits that we're looking at in the Act, but there might be other tax incentives that are available. It's outside the purview of what we're talking about today, but maybe some benefits under 179D deduction exist. And you could go down that path and look at that versus just focusing on the energy credits that are within the Act. Just to hit it home again, this direct pay is a game changer. Understanding what projects qualify for the direct pay, this is really going to assist with the financing of your projects. As Larry had indicated, you don't get your credit, you don't file for your credit until your project is complete. So think about the IRS timeline. We're in 2025, you put something in service maybe in June, but you can't claim that credit until perhaps you file your 2025 tax return or whatever document the IRS comes out with and says this is the process you go through. So again, understanding the timing, understanding everything across the board. Looking at your feasibility assessments on potential projects, and really, I'll use the word prioritizing what's in place that you want to move forward with because of those begun construction provisions, because of the requirements to say if we act now versus later, we might optimize our credit opportunity. So again, you're still doing everything within the context of what makes sense from a business perspective, But you want to say, let's grab that low hanging fruit if it's available to us, accelerate the project so that we can claim the credit. Going on to the next slide, again, begun construction, those terms so that we're certain that we're timing to maximize opportunities. What do we have to do from a practical perspective in order to say we have now begun construction? We've had a number of clients that have projects that maybe were already placed in service. So those projects perhaps don't qualify for the credit. But what about projects that you currently have underway? Are you looking at a placed in service date that you were thinking about placing it in service before the end of the year? Can we defer or actually hold on finalizing that project and placing it in service after December 31st of 2022 or 12/31 of this year, so we can again maximize our credit opportunities? So again, not doing anything wrong, you're just playing by the rules that are actually put out there with the act is how I would look at it, and making smart decisions. And I think the final item that we are really saying as far as next steps or action items, I think many of us that are on the call today are from our finance departments or our business offices learning about these opportunities. We have a number of individuals who are on our facilities or plant teams that are also participating in the call. But I think what we want to do is work collaboratively amongst our teams on campus or amongst our functional areas to develop a strategy to the financing and also our ESG related considerations, since these projects themselves are positive as far as checking certain boxes off our ESG related considerations or our initiative, but also propelling the campus forward when we look at our property, plant, and equipment and those energy efficient programs or projects that we're bringing aboard. And I think we have now, it'll be our third and final polling questions. So if you can open up your poll to the right of your screen, answer that question, and we will in essence get started and move into our Q&A session.